Hi guys, thank you very much for tuning into our latest webinar here at Skybound. We will very shortly be taking you through, or Glenn will, sorry, an in-depth dive into how to plan for a potential retirement into Europe and some other areas as well. My name's Ed. I'm the senior financial planner here at Skybound. My background is I've been over here for the last 10 years, looking after clients on a one-to-one basis. I'm qualified with the Chartered Institute for Securities and Investments, which is the UK regulatory board. I also studied private markets at Save Business School, which is part of the University of Oxford. And my job here is to help expats structure their wealth more efficiently. Now, Skybound, as many of you know, it's an independent, global, cross-border financial planning organization. We have licensed entities that are over here in the Middle East. We've got operations in the UK, in Europe, the US, typically many places around the world where there are concentrated expats that may currently be residing or maybe thinking about residing later on down the line. So without any further ado, I'm going to introduce you through to Glenn, who is going to talk you through a little bit more about his role here at Utmost and some common themes which we think are worth understanding or having an awareness of prior to considering a move to Europe. Over to you, Glenn.
That's fine, thanks, Ed. Yeah, so my name's Glenn McElroy. As Ed's mentioned there, I work for the Utmost Group, and in particular the wealth solutions side of that group. We are basically a life insurance company, and we provide investment solutions to internationally mobile clients, high net worth, ultra high net worth clients. We've got a range of products that fit into that mold for those guys. Yeah, we have, as I say, currently got about 58 billion worth of assets under management and over 530,000 customers across the globe. We've got office locations in the UK, the Isle of Man, Ireland, Guernsey, Switzerland, Dubai, Hong Kong, and Singapore. I think I've covered them all. So we've got a wide reach and wide experience of different nationalities, different markets, and how our products can actually fit into to a wealth plan. And before working for Utmost, my background is in the UK. So I worked for like UK life companies and financial companies. I have over 25 years of experience in the insurance market, both UK, Ireland, and now internationally. So yeah, so as part of my role, I talk to advisors like Ed's, and we look at different scenarios and try and put plans in place for clients using our type of products in order to make it more efficient for them. So yeah, so Ed's invited me along here today to kind of go into a little bit more detail about issues that we find that expatriate clients may have, when they move between countries, whether that's retiring into, as Ed mentioned there, Europe, or maybe moving back to their home country. We've got, we deal a lot with UK expats, maybe returning back into the UK. Although these days we find a lot of them are actually going to live in Spain, Portugal, and France, and Italy, and all these wonderful places where the climate's a little bit better. So we have a range of solutions that kind of can help with that process. So yeah, I've got a number of slides that I can talk you through, and we can kind of look at how that actually comes together and works. Right, okay. Yeah, as I said, we're going to look at some of those solutions for whenever you want to retire back into the UK or Europe, or the various jurisdictions that you might like to live in your retirement. We need to understand how your wealth plan actually interacts with the local regulations and tax and legislation in those countries. So it's not all the same. So we need to prepare for it so that we can mitigate against that re-entry shock. So today, what we're going to look at is basically the importance of tax and wealth planning, and how we go about utilizing products within a wealth plan in order to make them more tax efficient if you are to move into a jurisdiction. So that's the kind of the agenda for today. Right, so the first bit's the importance of tax planning in wealth management. Okay, so a lot of you will be living in a jurisdiction where you've got, tax-free income and tax-free, capital growth. So you can kind of forget sometimes about the impact that tax can have. However, in jurisdictions like the UAE, you find that, we've got a stat there, 88% of people are actually expatriate. And a lot of them will have an intention of moving to another jurisdiction to retire. They may be working in the UAE and decide that, as Ed mentioned earlier, that the healthcare system's better in the UK or the climate's better in Spain for them to retire into. So they need to plan for that move. But there's other aspects that they need to consider as well, such as family members who maybe reside overseas. That has an important impact on a wealth plan, because if you're looking at maybe passing on your wealth to family members who may be residents in the UK or France or Spain or Italy, you need to plan for that, because the inheritance regimes in these places are different. So you need to put in place a plan that actually caters for that. And also, if you've got assets that are based overseas as well, a lot of people will be coming into the UAE from other jurisdictions. You've got UK expatriates, may have ISAs and pensions, etc., that are based in the UK. How will they be treated if you don't go back into the UK? What happens if you move to Spain? How is an ISA going to be treated in Spain? Is it going to be tax efficient for you or not? And these are the considerations that you have to look at whenever you are planning for moving or retiring into another jurisdiction. So as Ed said, we come across a lot of different nationalities in this business, as we've got 8 offices around the world. So we're well used to dealing with different types of clients. And I just put up on screen here a lot of the clients that we would come across that are actually currently living in the UAE. So as you can see there, some of the key nationalities that we deal with are UK expatriates, South Africans, Australian, French, Italy, Spain, Portugal. And it used to be that a lot of these guys would be returning back into their home country, but we're finding now that they're becoming more portable. They're moving around, so they may fancy the retirement in Portugal, because Portugal's quite attractive for the tax regime there, or they may fancy Spain or France as another jurisdiction. So we're finding that it's not just returning expatriates to their home country, but it's actually retiring to other destinations, and that puts a little bit more complexity into a financial plan, because you really then have to start making it very portable, and you have to be speaking to the right people to ensure that you've got the plan in place that actually works for that type of movement. And the reason it's very important is because if you're going back into some of these countries, you're going to be facing a lot higher tax than you're currently experiencing in the likes of Dubai, etc. So the top rates of tax here in some of the key countries that we would deal with, like the UK, 45% top effective rate of tax. You look at Portugal, at 53%. And when you move and become resident in these countries, you're taxed on a worldwide basis. So they look at all income and gains that you make, even if your assets are based in another jurisdiction, and they will aim to tax those. And they also will tax those capital gains that you make. And another key thing that people kind of overlook as well is the whole idea of estate duty and gift tax. So this is actually distributing your wealth to your loved ones, your family members. And you have to make sure that there's a plan in place in order to efficiently transfer wealth, if you were to die, or even during life, if you want to start gifting money to your kids, etc. You need to make sure that the plan you have in place actually facilitates that, and you're not going to be penalized from a tax perspective.
Yeah. Glenn, I mean, just an interesting point there. You've mentioned that all of these jurisdictions will tax you on a worldwide basis, which I think is, to be honest, when I speak to clients, I quite often come across people who are under the impression that, I might have a house or a flat in Abu Dhabi or Dubai. I'm going to relocate back to Portugal, rent that place out, and use that to generate an income. I think that a lot of people don't necessarily understand how that's treated from a taxation perspective between the two different jurisdictions. Are any of these places do they have? Because again, if you look at perhaps a typical client base or people who spend time over here, do any of those jurisdictions have double taxation agreements with places like the UAE, where there'd be exemptions there from either capital gains or any form of income that they receive from investments in the Middle East?
Yeah, there's very few actually do have double taxation agreements with the UAE. It's when you're looking at taxation, like double taxation agreements, it's usually between like higher tax countries where there is, that potential for an increased tax liability because of the potential for being taxed twice in the two jurisdictions. But once you're resident, say in Portugal or Spain, as the table before states, you're going to be taxed on that worldwide basis. So even if you do have income coming through from rental properties, or you sell a house that's not in your jurisdiction of residence, there is potential for you to be taxed on the gains you make where you are resident.
So if you live in a zero income tax environment like the UAE as an example, and then the high rate in someone like France is 49%, and you're in that tax bracket, you sell a place over here, they're not going to charge you double taxation in the sense of you're not going to pay, if as an example it was 49% tax in the UAE, you're not going to pay 49% tax in both jurisdictions, but you'll just end up paying the higher rate in the place where it's due.
Yeah.
So your effective tax rate is still 49%.
49%. Yeah, exactly. Okay, so as I say, you need to be very aware of that. Whenever you do have assets that are in different jurisdictions, and you're living somewhere else different where that asset is located, and also when you move into those jurisdictions, you have to make sure that some of the assets that you hold aren't going to be penalised or taxed badly. Because not all structures are the same. And I think I mentioned earlier about, from the UK perspective, you've got ISAs and pensions and, general savings accounts, etc., that are all legislated for in the UK, and they've all got potential tax breaks and benefits in the UK. But when you leave the UK environment, then, you're going to be taxed in the jurisdiction where you're resident, as we described before. So you have to then look at how does that structure actually work in that jurisdiction. So in the UAE, it's not an issue, as you said, Ed. Zero tax, zero problem, really. But it's that future tax liability that you may have, because as we said, a lot of you out there probably thinking of maybe that retirement, as I said, in Spain, Portugal, France, etc. You have to be aware of the tax regimes in those jurisdictions, and how do they then tax the assets that you currently have, or the assets that you're building up while you're resident in the UAE. So that's when it's important then to make sure that your plan while you are resident in a zero tax jurisdiction is cognizant of the fact that you are going to potentially move out of that jurisdiction and withdraw income, or take the gains out of an investment whenever you're resident in that higher tax location. So some of these jurisdictions will have, targeted legislation against certain types of products. So again, if you look back at the UK expatriate side of things, using trusts in the UK is a very commonplace in a financial plan in order to kind of mitigate against inheritance tax. But if you were then to go into France with your trust, there's punitive tax regime in France, which will tax you as a settler of that trust. And it becomes less efficient for you. So you have to be aware of these things and try and put in place a plan that actually works or complements the local legislation.
Yeah, would that affect, because I mean, obviously the reasons why trusts work in places like the UK and they don't work in places like Europe is the difference between common law and civil law, and the structured or build up of that legal framework over a period of time using precedents in the UK's case and code, if you like, for Europe. But I believe anyway.
Yeah.
But could that also affect, because I think a lot of people are under the assumption of things like pensions as an example. You have a look at a UK pension and certain different formats, and particularly things like cure ups, because the cure ups you can get on a contract basis and you can get on a trust basis. And again, I don't want to go into perhaps too much detail here if it's going to confuse people, but if you have something like let's say a trust-based cure ups, which is one form of a cure up structure, could that potentially leave you open to tax liabilities that you weren't necessarily expecting if you were a resident in Europe and you held that kind of structure, or you're looking to draw down from that structure?
Yeah, there's definitely potential for that, because you do have like jurisdictions like France, and as you said, Ed, they're like civil law jurisdictions. They don't recognize the concept of trusts. However, in France, they've legislated to punitively tax a trust. So they don't recognize it, but they're going to tax it. So they do tend to, as they don't understand it, they will tax it. So a lot of those cure-ups that you're talking about there, you do get them as contractual arrangements. So, you know, if you're going back into a civil law jurisdiction, you know, and you want to make sure that you're protected against any potential attack that you know, the local tax authorities may have on a trust, then a contractual based cure-ups is probably the way to go. So it's, yeah, so it's introducing things, concepts like that make sure that you're in that more tax efficient plan for whenever you become resident in those jurisdictions. So yeah, no, that's a good example of it. And also things like succession and inheritance tax planning as well. That's kind of key, because you know, you can do a lot of planning in your local jurisdiction or your home jurisdiction or where you're domiciled for inheritance planning and succession planning. But then say you move into a civil law country where they have forced heirship rules, which, you know, force you to potentially you know, make sure that your wife inherits X amount, your kids gets Y, etc., etc. But that might not be the way you want to actually structure your inheritance or your succession. So it's making sure that you have structures in place that actually work in those jurisdictions to allow you to then you know, create that succession plan that you want, not what's kind of like dictated to you. So there's ways and means of doing that, and we'll come on to that in a little minute. Right, so we've probably covered a lot of this in the conversation, but so what are the actual benefits of portability and changing residency? Well, you know, if you have a portable plan in place, then the structure remains locally compliant. So you've done the work up front, and you know what it takes in order for your plan to actually work in the jurisdiction where you're going to become resident. And by doing that, you're adapting to the local tax laws. So you have products within your plan that actually work in those jurisdictions. And as I said, just there, you've got the estate planning adapted to the local mechanisms. So working within the local laws and regulations in the jurisdiction where you are. So you've got to giving yourself that security or that guarantee that, you know, your money's going to go to who you want it to go to. And again, it's the simplification of tax reporting in the new country of residence. If you're going into a country with a product that's not recognized in that jurisdiction, then you can have all sorts of trouble in terms of the, you know, how is it then recognized? How do I report my wealth in that jurisdiction? Is it taxed as income? Is it taxed as gains? And it creates a lot of you know, bureaucracy, headaches, paperwork, etc., in order to get that all sorted. So if you put in place a plan that actually works in that jurisdiction, then it reduces the or it creates simplification basically of the tax reporting. And then I've got the benefits here for the advice process, and I think this is crucial as well, because whenever you're talking about, say, retiring in a jurisdiction, that's a long-term plan that you're putting in place. So you don't want a plan that works in the currently works in the country where you are working or living, if that's not going to be where you're going to retire. So you want that plan to take into consideration your future move. So you need to be talking to an advisor that is aware of the implications for that move and has built all of that into the plan. So you've got that continuation. So that means there's no need to, you know, change your investment management arrangements or your strategy that you've set up now while you're resident, say, in the UAE, because that's going, you know, that's going to work whenever you go to retire into Spain. So it keeps that continuation. It allows you to plan for the long term. You don't have to sell up just before you move to France or Portugal or wherever it is, and then start afresh and reinvest and create you know, new investment portfolios. Everything can continue nicely in the new jurisdiction.
Yeah, I think as well that, you know, kind of from the conversation we've had so far, it looks like, and again, correct me if I'm wrong, but it seems that a lot of tax codes in Europe, they seem to, if they don't understand something, you know, like trusts as we've discussed, it's a case of shoot first and ask some questions first, ask some questions later when it comes to things like tax. Would you say that's a fair comment, which would probably further enhance the need to try and plan as soon as you can, realistically, if you are considering a move to somewhere in Europe? It doesn't seem like it can be something that can be done last minute.
It's definitely, it's like, prepare in advance. It's crucial because, if you are, if you're doing something at the last minute, you're looking at, the investment portfolio that you have in place may not be, a time to sell out of that investment portfolio whenever you're moving into a new jurisdiction. You want to maybe have that longevity within that product in order to make sure that it's there to work for you. Because as you say, as you move into a new jurisdiction, you haven't got that, you could potentially have to sell out of your assets in order to restructure your portfolio or your wealth plan in order to make it compliant at that time. So, you don't want that uncertainty, because as I say, you don't know where your portfolio is at that point in time. And, it gives you a little bit more confidence on that move, because you'll have got, other things to worry about if you're moving into or retiring into another jurisdiction rather than your wealth plans. So if you have that well sorted before you move, then it makes life a lot easier for when you do actually move into the new country.
Yeah, perfect.
Right, so I think if you're looking at your wealth plan and you want to see if it is actually robust and portable, I've got 4 key questions that you probably kind of have to ask yourself. And the first one here is, I think, most important, is can my wealth continue to accumulate tax efficiently if I return or if I retire into another country? And that's crucial for me because what you don't want is for you to move into a jurisdiction and find that your wealth plan is going to be taxed excessively. You want to make sure that if you move in, you're in control of when you actually get taxed. So you want your portfolio to be able to build up as efficiently as possible without any tax liability in the local jurisdiction, and then only get taxed whenever you wish to take money out or realize the gains from that investment portfolio. So that puts you in control then of your financial plan for whenever you do move into the new jurisdiction. And then that comes down nicely to the next point where we look at, well, can I draw my wealth tax efficiently? So again, you need to make sure that you're in products that work in that jurisdiction and you're making the most of the different tax reliefs that may be available in that jurisdiction. So again, you're not going to be taxed excessively on your investment portfolio and take away from the potential return that you can get there due to the tax position. So you want to make sure that your product fits nicely into the tax environment in your new country, and it makes the best use of the reliefs or the tax rates that are available, because as you well know, in various jurisdictions, different investments are taxed in different ways. So you need to make sure that you're in the correct product that is the most efficient for your needs. Then third point is, can I transfer my wealth tax efficiently? So this is all about succession planning. So making sure that the portfolio that you've got, so the wealth plan that you have in place, is able to be transferred between generations. So if you want to pass money on to your kids, you're going to university in the US or the UK or wherever, you can do that as efficiently as possible, and you're not going to be suffering any huge inheritance tax liabilities, or be forced to to implement a succession plan that isn't quite right for yourself, just because the local laws and regulations state that that's the way it has to be. And then again, is the structure flexible enough to adapt to changing circumstances? I mentioned earlier, a lot of you guys will be, maybe retiring back into, Spain, Portugal, Italy, France, and then potentially then there could be a move back into the UK, or you may move jurisdictions again. People are becoming more portable. So you want to make sure that your wealth plan can adapt and change as you move. So you may, have the plan geared up for a retirement in Spain, but if that doesn't actually materialize, or if you move to Spain and then move on from Spain to another jurisdiction, you want to make sure that there's products in place there that can adapt to that. So it's not like you mentioned earlier, Ed, having to sell out of things and buy into new products or new investments in new jurisdictions. So it's giving you that longevity within your plan, which is quite important.
Yeah, perfect.
Right, and as I said, I work for Utmost, and we provide insurance products that help with this cross-border wealth planning. So, what I do on a daily basis is talk to advisors like Ed, and we look at different scenarios and how we can actually implement plans for clients using our type of products. And these are some of the benefits that our products bring to that portable portfolio. Because first of all, insurance, it's a universally recognized concept. We talked earlier about ISAs and different types of investment that you may have, and how they need to be recognized in your jurisdiction where you're actually going to be withdrawing your income or you're taking out your wealth. Insurance is a well-recognized concept. There's legislation in place that will dictate how insurance products are taxed. Local authorities understand insurance and how it actually works. And you can use insurance as a very good investment vehicle because of the structure of the way insurance works. Because what the client, or you as a client, will have is an insurance contract that is issued by the insurance company. And then underlying that insurance company, this is where the investment side comes into play. So you'll have your range of investments and assets that are held inside that insurance contract. And that insurance, those investments are then owned by the insurance company. So you take away some of the liability of owning assets by owning the insurance contract that's linked to the value of the assets underlying it, which are owned by the insurance company. So that gives you a lot of benefits. That allows you to start looking at your tax planning, because you've got tax-free build-up of those assets inside that insurance contract because they're owned by the insurance company. They're not owned by the policyholder directly. So say you're moving into a jurisdiction which taxes capital gains annually. If you hold those assets directly, then you've got that capital gains liability on yourself, whereas inside that insurance contract, it's the insurance company owned underlying assets, and it protects them from any ongoing tax. So it allows those assets to roll up gross, so you don't have any tax on them.
But sorry, just a quick question.
Yeah.
For the client, is it possible that a client, let's say a client's got assets over, let's say a client's worked for a large multinational organization, he's got things like shares as an example, which he's worked with for a long time. He thought he's thinking about share portfolios. Could things like that, and let's say he wants to keep hold of those, but just make them a bit more tax efficient, could he, or could that expat potentially look into transferring those shares and ring fence those into a vehicle like this via one way or another?
Yeah, no, that's possible. Yeah, that definitely.
I appreciate we're looking at high level here, and there might be something.
Yeah, there's a lot of nuances, and it really depends on the jurisdictions that you're actually you're talking about there. Like for instance, like going back into the UK, there's that doesn't allow for the holding of our shares or taxes products. But in general, yes, because you're taking away the liability of owning those shares and putting them into the insurance contract, and then things like dividends coming through that normally would be classified as income and taxed as income if you hold them direct, can then roll up gross inside the insurance contract, because it's the insurance company that's receiving the dividends, not the policyholder. So there is there's things like that come into play, and also some things that are kind of overlooked with a lot of people that have US shares as well, and this potential for US estate tax if you hold assets over 60,000, even if you're not a US national. So if you hold over, you could potentially working for a US multinational with US shares that you've received from that employment, and if that's over 60,000, then you'll have to submit a return to the IRS in the US, declaring those, or well, your estate would have to submit a declaration when you passed away, and there could be potential for US estate tax on the ownership of those shares. Now there is double taxation agreements that potentially mitigate against that, but they're not widespread, so it's just something to look at. And again, another solution for that would be using an insurance-based contract and putting those shares into that insurance contract, which again takes it out of direct ownership and into the hands of the life company. So there's no estate tax on your death at that stage. So
is it the case of, let's say a client's got a US site to stock, but it's not held on, let's say, a US platform. Let's say someone's got either a private banking arrangement or a platform that could be in somewhere like Luxembourg as an example. But if he holds US Citus assets or US Citus stock on that platform, even though that platform is not necessarily in the US, is he then still, or is that, sorry, I keep saying, are they then still liable for potential US estate duty?
Yeah, they are indeed. Yeah, so even like nominee accounts that would exist in those type of arrangements. Yeah, it still falls back on the actual beneficial owner of those assets. Which is your client or the people out there that are listening to this. So yeah, there is potential for that US estate tax. I did say there is some double taxation agreements in place that can kind of mitigate against that. So like the UK and the US have a double taxation agreement, which will kind of work in the favor, so you're not taxed twice on your on the inheritance, or the state's not taxed twice on your death. So but there's lots of jurisdictions there that it doesn't work, and then you still have to do all the reporting anyway. Your executor of the will will have to report to the IRS the assets and go through the whole process of ensuring that there is no estate duty if it works within the rules of the DTA. So it can become quite a complex bureaucratic process in order to implement the terms of a double taxation agreement as well. But as I say, inside the insurance bond, you've got you kind of remove that issue.
Yeah, I think it's probably important as well to point out that this wouldn't be a necessary, well, it's a problem for all parties, but this would be down for the beneficiary to so upon the death of the person holding the assets, it's down to the beneficiary to try and navigate the taxation of that as well.
Yeah, exactly. So it's when you're distributing the assets of the estate, then yeah, so it's up to like the executors of the will, or the person dealing with that estate, in order to do file the correct forms, etc., and go through the whole probate process as well, which is an extra burden. And again, using I'll come on to actually succession planning in a second, but yeah, so that's using an insurance contract takes that headache out of the equation whenever you're dealing with an estate like that. Yeah. So sorry,
I was just going to say, well, I would imagine as well, looking at how widespread things are, well, looking at common reporting standards as an example, the world's kind of getting smaller and smaller for people who might be thinking, perhaps we can navigate that kind of grey area and hide assets away, presumably with more and more places signing up to CRS. That the world is getting a lot smaller to potentially try and hide something, and something like a PPLI, which is tried and tested, I would imagine probably the most.
Yeah, totally. Exactly, and that's actually my next point, is the whole simplification of things. Yeah, because it is extremely difficult to hide anything, because like as you said, common reporting standards means that most jurisdictions now have to kind of report movements and assets of individuals that are not resident there, etc. So yeah, so it all becomes quite tricky. But with the insurance contract, again, you've got simplification and all of that. There's like simplified reporting under CRS, because you really only have one line of stock, basically, which is the insurance contract, and then all the assets underlying that insurance contract, which gives the insurance contract its value, are owned by the insurance company, so they don't need to be reported. And also gives you a little bit of confidentiality on assets that you hold within that portfolio. And again, there's no need to segregate income and capital, because as we mentioned before, like dividends that are maybe coming into your portfolio within the insurance contract, again, that income is the income of the life company that owns those assets. So there's no need for you to be reporting income in your portfolio. It can all fall within the insurance contract. which is quite handy. And then the last point here is like it's on succession planning. So again, with insurance-based contracts, you can nominate beneficiaries, and you can use complementary structures like trusts. And we'll just come on to that in a second. So this is basically the overview of how it actually works. So the policyholder becomes the insured person. So you would set up the contract, you would put yourself down as the life assured. And then you nominate the beneficiaries of that policy. So during your life, you can dip into your insurance policy. You can take assets out as and when you require them. That's not a problem. But on death, then you have you know that you have your beneficiaries nominated on that contract, so they can pass easily outside of your estate to those beneficiaries. So you avoid things like the estate taxes that we potentially talked about, or the forced heirship in certain jurisdictions that can come into play if your assets fall within your estate. So this kind of creates like a mini estate that can be administered separately to what you potentially would have in your will. So it gives all that privacy of succession planning. And no delays, which is another crucial one, because we talked there about US assets and the forms that you have to fill in potentially if you've got US assets in your portfolio, in order to get them tax free, etc., or free of US gift taxes, etc. So which can take up to a year in order for the assets to be released, whereas inside the insurance policy, we as an insurance company will pay out that death benefit to your loved ones whenever you pass away. There's no issue with them getting that money released, and it's going to who you want it to go to, which is crucial. Okay, so we looked earlier at the top rates of tax in the various jurisdictions, and how high they potentially can be. But if you introduce the insurance contract into your wealth plan, then you've got the potential then to mitigate against a lot of those taxes. So as I say it, you kind of got three different areas to look at here. So the insurance contract can either make use of tax reliefs that exist in various countries. So example there being, if you look at the United Kingdom, if you look at bringing back an investment bond or an insurance contract into the UK, you've got various tax reliefs that apply, and they're written in legislation in order to permit it. So you've got things like, you can draw down 5% of your premium per annum without any immediate tax liability. So this allows you to draw the capital out of your contract without actually paying tax on any gains that you've made. So you can do that until you have 100% of your capital has been reduced. So it's 5% per annum over 20 years, basically.
Those 5% are cumulative as well, aren't they? So
yeah,
if you use 2% one year, you can roll that 3% into further years.
Exactly. Or if you don't touch it for the 20 years, you can take 100% of the original capital out, yeah, without any tax liability. And then, you can make use of the fact that you are non-resident as well. Whenever you take out your policy and you've lived abroad for a while, the UK won't tax you on that period of non-residency as a proportion of the overall gains. So that's another way of reducing any tax liability. And then there's other ways in other jurisdictions that they make insurance contracts a little bit more tax efficient. We talked about income coming into the policy. If you look at South Africa there, all the income that comes into a policy is basically recapitalized, becomes capital, and you've got that tax differentiation between income and capital. Capital is taxed at 18%, whereas income would be up to 45%, basically in your marginal rate. So that's income is recapitalized within the contract and becomes more tax efficient. And then there's there's legislation in place in other countries which basically reduce the tax liability. So in Australia, using an insurance-based investment contract, after 10 years, you can basically get tax-free access to your portfolio or your wealth, which is inside that insurance contract, which is extremely tax efficient. But in the likes of Italy, Spain, and Portugal, there's reduced rates of tax that apply to insurance-based contracts. And again, the insurance contract has to be structured in a way that complies with the the local legislation. And that's where we come into play as a company. We can make sure that the contracts that you're in, and whenever you move into these jurisdictions, are compliant with those local regulations in order to take advantage of the tax reliefs that exist. So yeah, that was you know, a very quick overview of, you know, some of the considerations that you need to think about or look at whenever you kind of move jurisdiction. So as I said, you know, the key thing about, you know, going into a new jurisdiction is the fact that, you know, you've got potentially high taxes that you have to prepare to pay for, or else plan to mitigate against those. And as I said, you know, the tax basis in these countries is all on a worldwide basis. So it's, you know, there's no hiding from that tax. You can't just, you know, you move your money into a contract and you're, you know, the country that you were previously living in, expect not to be taxed in that. So a lot of what you want to mitigate against from a tax perspective can be catered for through the use of insurance-based contract that we offer. So yeah, so there's a lot of benefits to ensuring that you've got your plan in place, and includes products like the ones that we have in order to make sure that that portability is there in the contract and in your plan. And that's really it, Ed, from my perspective.
I think you covered off some. I think you've covered off some quite in-depth areas there in terms of, you know, the different nuances between different jurisdictions and the way that things are taxed. And I think you covered up as well a lot of the misconceptions that I think that people have, which is, you know, I've got an ISA and it's tax-free in the UK. You know, I presume it's going to be tax-free for me once I go to, you know, France or Spain or Portugal. And of course, I think as well, when it comes to how long you can actually spend there, because I think, again, a lot of people that I come across to and I speak to, typically they plan on spending, you know, certain time in France or certain times in the UK, or, you know, other times in, you know, other parts of the world. And it's actually relatively easy to fall into perhaps the pitfall of becoming a tax resident in one of these jurisdictions almost accidentally, just because, you know, you might be spending more time in that country than any other single country. And I think it's important to be aware of how those assets will be taxed and how you can protect against taxation of these assets. I think it's incredibly important, particularly as I said to you before, you know, the world's almost getting smaller from a CRS perspective, and banks, institutions, you know, they're all communicating with each other.
Yeah, no, that's very true. And what you said there is, like, you know, people are moving between jurisdictions quite a bit, and it is quite easy to potentially be taxed in a jurisdiction or become resident in jurisdiction subject to tax in that jurisdiction, you know, quite quickly, without actually realizing it. And especially if you're coming from a jurisdiction which with zero tax on you know, income or assets, then, you know, it's something that maybe is not high up in your radar whenever you do kind of move. So it's making sure that you're well aware of it, and you have got the, you know, the products and the plan in place that actually caters for it.
Yeah, no, perfect. Well, thank you very much. That's been very insightful, very useful, and you've managed to make things like taxation quite interesting as well, which I know isn't always the easiest thing to do. Glenn, so if it's okay with you, we've got a couple of questions that I think people put into the chat box. One is from Richard, who has said that he's worked for a US multinational for many years during his career, and during that time period, he's built up quite a large share portfolio. Now, currently, he believes he's, I can't say the name, but he's looked after by an audit firm. However, they've not mentioned anything in line of inheritance tax, and if he is potentially liable for that. And he's put overview, he's originally from the UK and he's likely going to be retiring in Portugal. Now, could you perhaps find some insight there in terms of if that tax is likely to be, if he's potentially at risk from inheritance tax?
Yeah, it's one that you really need to take a little bit of advice on. In particularly domicile and residency, are quite complex areas. I did mention when we had we were talking about this earlier in the presentation about double taxation agreements that can come into play between different jurisdictions. So, and I know that the UK and the US have a double taxation agreement, which will kind of mitigate against estate tax in the US or inheritance tax in the UK. But it's, we would need to understand, Richard's domicile, where he's actually, is he still UK domiciled, or was he originally domiciled in the UK? I know it's very difficult if you are domiciled in the UK to lose that domicile. So there's potential for UK inheritance tax liability in those shares. And then if he's not UK domiciled and he's he's taken up a domicile choice, say in Portugal, then you need to look at the potential, is there a double taxation agreement between Portugal and the US that covers estate taxes? So it's something that you really need to kind of look at in more depth. If there is no double taxation agreements in play, and there is the potential then for US estate tax on those assets, as I said, anything over 60,000, that's US domiciled assets, you then have to go through that whole process of reporting that to the IRS and, potentially having an estate tax duty on that, which is up to 40%, I believe. But it's one that you really do need to really start, working with an advisor to get the groundwork in terms of understanding your domicile and residency status and how that interacts with the assets that you own.
Thank you very much. Hopefully that answers Richard's question. There's another question here from Thomas, who is based over here in the UAE, and he has said that even though he's worked in the UK, he's not originally from the UK. However, he is likely going to be going back to his home country, which is France, more specifically the south of France. Now, he's asked the money that he has built up over here, if he could place that into one of these types of structures to protect from taxation in France later on down the line. And he's also asked that he's looked into this before, but believes there's a time period where he needs to have had the vehicle for to maintain full tax efficiency.
Yeah.
Sound familiar?
Yeah, no, that does sound familiar. So he's probably heard of a contract called an insurance fee contract that works in France. Yeah, so that's like a tax efficient insurance contract basically for French residents. Now we're not allowed to provide any, we're not regulated in order to provide financial advice
Of course.
for individuals, but generally speaking, yes, if you were to utilize an insurance contract that was recognized within France, then you do get French tax benefits, like reduced rates of income tax after that 8-year qualifying period, which I believe he's referring to. So your tax rate reduces quite significantly after 8 years on any gains that you make on that contract.
Perfect. Well, thank you very much. I mean, that sounds pretty clear to me. And then I'm not going to go into this too much because I'm conscious of time, but a question from Christian, who's mentioned he works in the financial sector himself and manages his own money. Now, he's interested in exploring the ways that he can look to protect himself from taxation. However, he wants to gain an understanding as to whether, if he has something like this, whether he can manage his own investments within the vehicle itself. I imagine there's probably some stipulations there in terms of what you can hold and what you can't hold, but
yeah, again, it'll depend on his future intentions. Like when he's resident in the UAE, for instance, he can look at managing the investments that are held within that portfolio, or working with an advisor to do so, or you could outsource that if required. So that's not what the Christian it seems to want to do, but you've got a range of different options on how those assets are managed, so that there's full flexibility on that. Now, the issue arises whenever you potentially move into another jurisdiction that has more restrictions in terms of the assets that are held within a portfolio bond or an insurance contract. So like the UK, they've they tax heavily on what they call personalized bonds, which are insurance contracts that hold shares and personalized assets. So you'd have to kind of restructure that so you're into pooled assets. Or in Spain, for instance, you have to invest within recognized funds that UCIT funds that are recognized within Spain, so you can't kind of stray outside of those parameters, and that has to be in place from the start. So there's so there is flexibility within the products, but again, you have to be mindful of potentially where you're going to retire to, and then make sure that your product is suitable, or your investments are suitable for that jurisdiction. And that's the benefit of working with guys like you, Ed, that you can do that. You have an understanding of what can be held within the contract, and then tailor it to the needs of the client.
Yeah, and work very closely with experts like yourself, Glenn, as well.
Yeah.
Okay, well, thank you. I think that's all we're going to have time for. There's a couple more questions in there, but I don't think we have time to go through all of these. But Glenn, thank you very much for your time today. It's been very interesting, and you've covered off a lot of areas there. So thank you very much. I'm sure the people that are watching this now live will appreciate the additional help and information that you provided. And of course, prior to undertaking anything or taking out any, following on from any of this that we've covered off today, please make sure that you always speak to an advisor, as long as this takes into consideration, your own personal circumstances or goals or objectives.